Hello everyone, I'm John Cunnison. I'm the Chief Investment Officer at Baker Boyer Bank, and I want to welcome you all to our monthly market update. Today I want to talk to you a little bit about what I call the Goldilocks economy. So this is an economy that faces a lot of headwinds, primarily from the Federal Reserve. As many of you know, in order to contain inflation that was a result of pandemic stimulus, the Federal Reserve has increased the Fed funds rate, or interest rates, has increased those rates faster than we've seen since the late 1970s and early 1980s under Volcker. So typically, when you see interest rates go up that quickly, right, it makes borrowing more expensive, right? It begins to slow economic transactions. And typically what you see is it pushes an economy into a recession. And that's ultimately what the Federal Reserve is trying to do, or at least just slow the economy to contain inflation. Now, at the end of 2021, if I asked 10 economists, what would happen if the Federal Reserve increased interest rates, or the Fed funds rate, from 0% to 5.25%, right? Making borrowing much, much more expensive. If I said to those economists, what would happen if the Federal Reserve did that and they did it over a very compressed time period, year and a half? Most economists would say you'd almost certainly see a recession. And here we sit today, not only do we not have a recession, we have fairly robust GDP readings. So the last GDP reading was strong. We see the labor market. So we're going from a very, very tight labor market where it's hard for businesses to hire new people because it's so tight. We want that to loosen a bit, right? We actually want unemployment to come up a little bit because that tends to put downward pressure on inflation. And we're seeing that, right? But we're not seeing it go up too fast or too high or too quickly. Again, a Goldilocks move in the labor market. And for wages also are still rising, and they're rising at a fairly good clip, but not so quickly that they're going to exacerbate the inflation problem. And ultimately, if we look at the goal of the Federal Reserve, what are they trying to do? Well, they're trying to bring inflation down, right? And typically what we've seen when we've seen inflation that is over 8%, if we ask the question, looking back in history at all the data, on average, how long does it take to get inflation from over 8% down to the target of 2%? Well, if we look at history, on average, it takes about a decade, thereabout. And most people are predicting, and we're actually getting pretty close now, right? We're in that 3 to 4% inflation range now. And many economists are predicting we could see target inflation by the end of 2024 or sometime in 2025. That would represent a very quick decline in inflation. So inflation is coming down. The Federal Reserve policies, at least as far as we can see right now, are working. And the outcome for the economy so far is about as good as we could have contemplated at the end of 2021. So there's good news on that front. Now, that doesn't mean that we won't see a recession in the future. We very well could. But the pace of the decline in inflation and the resilience of the economy thus far are very encouraging. Now, when we look at markets, right now we've seen that the equity markets have responded to this good news that I'm describing. So we've seen fairly good returns this year. We haven't made up for all of the losses we saw in 2022, but for a good portion of them we have. Valuations still remain what we would call fair in the US. Internationally, they look attractive. It's important to maintaining a meaningful allocation to international equities, we would argue. And if we look at bonds were probably one of the most discouraging places to try to invest 2 years ago when interest rates were very, very low. Today, those interest rates are much higher. If we buy a new bond today, the interest rates that we can expect are between 4 and 7%, depending on the type of bond. That's quite attractive. So as you're reading headlines, and some of the headlines will, look dire, predict recessions, things like that, it's really important to remember that the economy and the markets can surprise us. Many of the things that you're reading may already be priced into markets. So when you're contemplating making changes in your investment portfolio, be sure that you're making those changes based on your personal financial situation, what your financial plan tells you, not based on, your prognostication of where the economy or the markets might go. If you have any questions about this or anything else, please feel free to reach out to a member of your Baker Boyer team and we'd be happy to help. Thanks for joining me.